All right. Annual percentage rate and effective annual rate. Now, in the previous video, we talked about the frequency of compounding and, realized from the point of view of an investor that the more compounding periods, the better. But obviously, as a loan, meaning if you're borrowing, then maybe that's not so good. I mean, in case of borrowing, you want lower rate and less compounding frequency. But as an investor, well, the opposite. And we also know that interest rates are stated as an annual rate. The rate quoted is often the annual percentage rate, or APR. So the rates that you see when you want to open a savings account or when you want to get a loan or on your credit card, those are all APR. Now, why do we need effective annual rate? Well, in order to understand why EAR, or effective annual rate, matters, let's start with a problem. Let's say you're presented with two investment options. Investment A and B. Investment A with a 5.09% annual rate compounded annually. Investment B with a 5% annual rate compounded quarterly. Now we want to know which one should we choose? Which one is better? We can't compare these two directly because, they have different compounding periods, right? Different frequencies. One is annual, the other one is quarterly. One has a higher rate, but the other one has more compounding frequencies. So which one is better? Now, before we figure out which one is a better deal, first of all, this rate that you see here, and in terms of investment A and B, the rates are both APR. Right? Interest rates are stated as an annual rate. So the rates that you see are annual rates. Okay, great. Now, in case of investment A, because it is compounded annually, well, nothing changes. So it is APR. But this one, our rate is annual rate, but it is compounded quarterly. So I have to find a way to turn this one also into an annual rate. In other words, find the effective annual rate of investment B. Then I can compare it to this one. And to do that, that's the formula. Effective annual rate, EAR, is equal to 1 plus APR divided by m to the power of m minus 1. What is m? M, the number of periods per year. Okay, great. So let's do that. Investment B, our APR here is 5%. So our EAR is equal to 1 plus decimal way 5 divided by m. What is our m? Compounded quarterly. So m is 4 to the power of m, again compounded quarterly, 4 minus 1. So this becomes 0.125. So 1 plus this, that will be 1.0125 to the power of 4. The whole thing becomes 1.0509 minus 1. It becomes 0.9. Percentage-wise, that will be 5.09%. So investment A and B, well, no difference. They're the same thing. At least they're saying the same thing. One has higher rate, the other one has more compounding frequencies. So you can think of it this way. $1 investment earning 5.09% compounded annually grows to the same future value at the end of 1 year as $1 investment earning 5% compounded quarterly. They are saying the same thing. And as you can see how useful EAR is. In this example, they were saying the same thing, but we will do some other examples, and then you will see without knowing how to turn one into, effective annual rate, it is impossible to compare and to know which one is a better deal. So, EAR, effective annual rate, is necessary when comparing investments that have different compounding periods. Okay, now before we do one more example, let's take a look at this table. Now in this table we have different frequencies: annual, semi-annual, quarterly, monthly, and daily, and we want to know what happens to the future value of $1. So the APR is assumed to be 8%. So a dollar investment earning interest of 8% compounded annually, the future value of that $1 will be $1.08. 8% compounded semi-annually, 8 is adjusted, divided by 2, remember, right? To the power of 2, the future value of $1 is $0.0816. All the way through daily, 8% compounded daily, 8 divided by 365. So $1 investment with 8% compounded daily will turn into $0.083278. Now, if you can recall, the formula for the EAR was EAR, effective annual rate, 1 plus APR divided by m to the power of m minus 1. So let's take the monthly compounding up to over here. We have we are following the formula, so this one minus 1. Let me write it over here. So that will be 1.083 minus 1. That will be 83, which is 8.30%, meaning 8% compounded monthly will yield an effective annual rate of 8.30%. So we are annualizing this monthly compounding period. We are turning into an annual rate. So there is no difference between saying 8% compounded monthly or 8.30% annual rate. They're the same thing. An APR of 8.30% is equal to 8% annual rate compounded monthly. They will yield the same future value because they are the same. We turn that compounding, that monthly compounding period into an annualized rate. Okay, let's do one example to sort of put everything together. So, a credit card charges interest at an APR of 15.24%, compounded daily. Now, when you're looking at this rate, the APR of 15.24%, some might think that, okay, if I spend $100 and then 1 year goes by, so the interest that they will charge me will be 15.24%, which is wrong, because that 15.24% is compounded daily. So if you spend $100 and do not pay that back for the whole year, in order to know how much you really owe, you have to find the effective annual rate. So we have to take all this and annualize it. Okay, so let's use the formula. EAR is equal to 1 plus APR divided by m to the power of m minus 1. Right? So 1 plus APR, put it in the decimal way, 1524 divided by m, compounded daily, 365 to the power of m again, 365 minus 1. This whole thing becomes 1.00417534 to the power of 365 minus 1. Again, this with the power term becomes 1.164588 minus 1. If you round it up, that'll be 1646 percentage, 16.46%. Meaning, if you spend $100 and do not pay it back for a year, that's the amount that you'll be charged with, not 15.24%. The rate, the effective rate that they will charge you is 16.46%.